Everyone, thanks for joining us today for our financial and market update. Of course, this is Jeff Carbone of Cornerstone Wealth, along with Cliff Hodge, our partner and CIO at Cornerstone Wealth Group. Cliff, welcome. Hope you're having a good day.
Great to be with you as always, Jeff.
Perfect. Well, Cliff, as we approach Halloween, I'm sure today we're going to discuss maybe that creepy inflation, maybe talk about that some scary earnings, although maybe not so scary. Or maybe we could talk the ghoulish Fed. Try to come up with all the Halloween things that I can come up with today. Well, as always, Cliff and I are going to take a look back, maybe at 2023 so far, 10 months in, or I guess 10 and a half now. We're going to do a little bit of market review, market outlook, discuss in that what's going on with interest rates. We'll talk again, war, whether Ukraine and Russia. Now, what is Israel, Hamas, Iran? Where does that all come to play? We'll talk all of that. Talk about portfolio positioning with all that's going on and the implications as we close out the year. Following Cliff in the market update, I'll just do a little year-end tax planning as we close out 2023 as well. So thank you again. Welcome. And just a reminder, Ashley is recording the session this afternoon. So if you missed something, want to hear it again, we'll have a replay out to you here in a few days. If you want to share it with colleagues, friends, family, someone that you think or other people that you think may like to hear, have some questions about the market and economy, send it along. We'll try and take a few questions. So at the bottom, if there's the question screen where you could put in your question, and we'll look to take a few at the end given time parameters. So Cliff, we're seeing inflation start to moderate a bit here from the high when we're seeing not over 9. Now we're coming down in the mid 4s. We're seeing the Fed and the chairman's language, whether it be Powell or the other governors. Are we done? Will interest rates remain, the language from them, higher rates for longer? How much longer or how long? We'll talk about that. Again, we've seen devastation with Hamas not invasion, but bombing in Israel. And the death toll has risen significantly. So sorry, our prayers go out to everyone in Israel. And we're thinking about you. Big earnings week. We just had there's Microsoft come through, but a few tech companies coming through with earnings. We'll continue to keep an eye on where earnings are coming in. We've got this week, next week, and probably the week after the biggest weeks of earnings coming in, and we're going to keep a sharp watch and what we're seeing there amongst others. But we're seeing slowing economic conditions and how that may kind of gravitate us towards certain areas versus others. We also come with about 3 weeks ago, we saw the ending of the deferment of student loans. So now we are responsible. If you have a student debt, you need to be paying once again. So it's just a reminder of the COVID relief money that many had or received is continuing to be exhausted and close to the end from whatever's left. So Cliff, lots of catalysts to go over this afternoon. So I'm going to hand it over to you. Thanks again, as always, for the investment team, your time and the energy that you put into this and overseeing the assets here at Cornerstone. So let's jump in and start sharing some updates.
Thanks, Jeff. Yeah, and there's certainly no shortage of market moving events so far in 2023, and as I'm sure there will be much more to come. But we'll start with a review as we always do, just looking at what's transpired year to date. And as you can see, what look like pretty significant or reasonable returns at the index level is really been really focused on a narrow subset of growth stocks that have some sort of connection to AI. You mentioned Microsoft. Google is another one that's reporting after hours. And as you can see from a sector perspective, things like communication services and technology, consumer discretionary, where a lot of these magnificent 7 stocks that live, what we've talked about, is really where you're seeing strength. Whereas broadly, and this is across both defensive and cyclical areas of the markets, we've seen more modest or even negative returns. I'll also call out bonds, as you can see highlighted on the left with the U.S. Aggregate Bond Index. It's essentially the S&P 500 for the bond market, down 3.1% year to date. This is as of this weekend when we put this together, trending toward the third down year on record for bonds, which is certainly something that we've never seen before. We get it's certainly been a challenging environment for fixed income investors, but really the flip side is that as rates have risen, go forward returns in bonds look a lot more favorable because the yield obviously is going to be the major component of the return that investors receive. So I'll talk about just how narrow this market rally is, and I've updated the slide here to look at the S&P 500 versus the Magnificent Seven. Whereas you can see now that the Magnificent Seven has accounted for more than 100% of the return of the index year to date. You take those out, the broader S&P 493, as we've coined it, is down, is negative on the year so far. And just how historic is this narrow concentration of strength? As you can see on the graphic on the right, going back to the early 90s, we've never seen a time period where the top 10 have accounted for all of the index returns. We've gotten close before in years like 2007, 2020, 1999, 2021. What do all these have in common? Well, they've all preceded corrections or weak equity markets, and so certainly not a great sign. Typically for broad-based equity strength, you want to see broad participation, not just concentration in a handful of stocks. And so if we zoom out and just take a 2-year period going from October 21 to now October 23, you can just see how much of a challenging environment it has been for really all assets. Stocks are down. We've got the S&P, the Dow, the NASDAQ, Russell 2000, all in the red on the equity side. And then same story on the bond side with the ag, which we mentioned on the prior slide, down 15, and high yield bonds down 7. And so there really hasn't been anywhere to hide, and just goes to show again, while the S&P and some stocks are up this year, we still have yet to make up for losses in 2022. And I'll emphasize this is why we put such an emphasis on limiting downside, because it's much more important. Much more impactful to long-term portfolio results. So Jeff, we've gone from the Fed's war on inflation to a war in Europe with Russia and Ukraine, now to war in the Middle East, unfortunately. And as you mentioned, we certainly do want to take a moment to acknowledge the human tragedy that's just certainly been awful and heinous on so many different fronts. Our hearts and go out to all those who've been affected. Our thoughts and prayers are certainly with you, and for a quick resolution. And in our role, it can certainly be difficult to try and separate the human impact from the market impact. But as our job as fiduciaries and advisors, that's the lens that we're going to focus on today, the market impact. And by and large, it's really going to hinge on Iran. Still, there are conflicting reports coming out as to the depth of their involvement with planning and execution on the attacks in Israel, and we're certainly going to be keeping an eye on some indicators that would point toward a broader escalation, which is really going to be focused on Hezbollah in Lebanon and I believe in Syria as well, who are known proxies of Iran. We do know that the Biden administration is going to prefer to delay any major action until after the election. And so far, we're very in very early stages, but so far the chaos has been relatively contained. Though we will highlight one major risk. We've called it out here on this fourth bullet point. If there is a broader escalation or direct conflict between Israel and Iran, certainly the prospects of a global oil shock over the next year have certainly risen with their probabilities. I came across this graphic. I thought the economics team at Bloomberg did a nice job just kind of gaming out some different scenarios. Good framework to think about the potential impacts both on oil, on GDP and inflation, kind of ranging from $4 a barrel impact to oil in a confined war, which largely stayed in Gaza, up to a $64 a barrel impact on oil prices and a 1% hit to global GDP. If there is a direct conflict between Israel and Iran that spills over into the broad Middle East. So for now, we think the probabilities favor more of a confined war or perhaps even a proxy war. But our job is to think about risk and try and manage it. And as we can see, Jeff, there's no shortage of market moving events in 2023. And we haven't even gotten into the developments in DC, which could warrant a call in and of themselves, and are certainly going to come more into focus in an election year in 2024.
No, absolutely, Cliff. I mean, I think that I'm sure in our Q1 or I should say Q4 wrap up come January, that will be top of mind, and I know it's top of mind already for most folks in terms of the election next year. One of the things that was also interesting, Cliff, in the slide where the Magnificent Seven, I don't know if anybody else noticed, but the Magnificent Seven really has been narrowed down to Magnificent Six, because that one slide that Tesla, who had a good start, there's a little blip on top of that where we can't even fit Tesla in there anymore, but they've come off fairly significantly here in as we rounded out August and September and now October. So again, as always, Cliff, there's a lot of catalysts. Again, war, interest rates, what the Fed's going to do. So as we look back, but now let's start looking forward into the fourth quarter outlook, and maybe even talk a little bit of what we're watching for the early part of 2024.
Yeah, thanks for the summary, Jeff. Yeah, the only constant has changed in this business, and as you know, been doing it quite a long time, and so we're constantly just assessing the situation and trying to understand the different impacts that may develop over different scenarios, and that's really our role as advisors for our clients. So looking forward, really the major takeaway is that in our estimation, the world has changed. And that's going to have pretty dramatic impacts to asset class returns, financial markets, and portfolio construction. And if you think about it, over the last 20 years or longer, really, we've had this kind of low inflationary environment characterized by low interest rates. Globalization has been a major driving force, and by and large, we've had a pretty stable global order, led by the U.S. involvement as kind of the main power on the global stage. And then you think about where we are today, right? We have a 40-year high in inflation, which has catalyzed the most aggressive tightening cycle from the Federal Reserve in 30 or 40 years. So we've got interest rates at high levels. We've got this new phenomenon of onshoring or nearshoring, right, which is a break from globalization to more a regionalization kind of model. And we've got the U.S. beginning to pull back a bit from the global stage, with the withdrawal in Afghanistan being a recent example. And this largely is corroborated by fundamentals, right? So valuations are high when we look at it from an equity perspective. Earnings have been in decline for the last 3 quarters, yet expectations are still pretty high moving forward. But then lastly, in the shorter term, on the positive side, we have seen a shift in sentiment among the major cohorts and investors that we track, right? Being institutions, what we refer to as the machine, which is our kind of catch-all for all the systematic rules-based algorithmic traders, and then retail investors. So this really sets the stage for a bit of a push-pull into year-end and beyond, and really makes us pause and think about what we should be doing from our clients from a risk perspective and from a portfolio construction perspective. And so why do we think that the world has changed? What's been the major driver? And as you can see from this really long-term chart of interest rates going back to the 60s, really the major foundation of financial markets over the past 40 years has been the structural decline in interest rates. And as you can see on the graph on the screen here, that trend has largely broken when rates bottomed in 2020 and 2021, and the Fed began in earnest this hiking cycle, which has now pushed yields to 5.5% on Fed funds and nearly 5% in treasuries. The highest we've seen since the before the global financial crisis in 2008 and 9. And so then we think about who were the winners in this low rate kind of easy money environment, and then who may be the winners going forward. And as you can see, this just going back to 2006, I pulled some various asset class returns, things like private equity, growth, technology stocks. And generally those who've kind of embraced this notion of FOMO, or fear of missing out, have been the winners in this kind of structural low rate environment. So then you begin to think about, okay, well, if we're right and the world has changed and we're in this higher inflation, kind of higher for longer interest rate environment, who are likely the winners of this new paradigm? And I've kind of taken a stab at some of that here on the bottom, just in general, but you can think about it from a structure of lenders over borrowers, right? So those that have the capital or lending it out to get a rate of return are going to do better in a higher rate environment. So credit, both on the public side and on the private side, we think is going to become more impactful. And then just in general, investments that are driven more by fundamentals, right, rather than emotions. So perhaps value stocks over growth stocks. We'll look at global valuations here momentarily, but perhaps international relative to the U.S. becomes more interesting in this new paradigm. And we're certainly not the only ones that have this view. These are the 20-year capital market assumptions from Fidelity, were recently published. And really the key takeaway here is that returns going forward in the traditional asset space, you look at these 20-year forecast numbers, and they're real returns. So you do have to add inflation back into these numbers to get nominal. But they're likely going to be lower than where they have been. And so for us as advisors and asset managers, that really is going to introduce the need for more creativity in portfolio construction in order for our clients to maintain the successful results that they have. And is really one of the main reasons why we've made a push into alternatives and expect their role both as diversifiers, but also return enhancers or return amplifiers to be of increasing importance going forward. So, many are going to be familiar with our dashboard, which is this graphic I've got here. So visual, encapsulation of our investment process, which are really driven by three legs of our stool, if you want to call it that. So first being the macro, then fundamentals, and then lastly behavioral. And another way to think about this is over varying time frames. Right. So we believe that macro and fundamentals are more of a long-term orientation, whereas behavioral can influence flows, which drive market movements over shorter-term time periods. And so just looking at this mosaic here, you can see that while long-term certainly some challenges remain, right, until we go through a recessionary period, the Fed begins to cut rates and go to more of an easing stance rather than a tightening stance. Valuations reset, earnings fall, expectations fall, and then we will be in certainly a much better place for longer term purposes. However, over the shorter term, as we think about year end and into early 24, we do think the dynamics are in place for some upside. I'm not going to go through all these, but we'll certainly hit on some quick call outs, and the first of which is an update on the quads. Just as a reminder, we're looking at year-over-year rates of change, and that rate of change piece is important. That's really what we care about. And we use the quads as our GPS to navigate the longer-term cycle in real time. And so what this shows is that while the economy has remained resilient, right, growth continues to hold up, though at a slower pace, and inflation begins to fall. We think those trends are likely to continue over the coming quarters, right? Supporting a lower growth, kind of falling inflation environment, which historically are the kinds of periods that have been really supportive for bonds and much less favorable for stocks. So then we kind of pivot and take a look at our view of the Fed. And this is a little bit of a busy graphic here, but what this is the dot plot that the Fed releases every quarter. And each of these yellow dots that you see on the screen are long-term interest rate projections by each member of the voting committee of the Federal Reserve. And then the green line that goes through kind of diagonally there is the median. And so the takeaway here is that on the one hand, the Fed is near the end of their hiking cycle, right? We're currently at a 5.5% target Fed funds rate. They've got the potential for maybe one more rate hike priced in 2023 and then being done. If you look at what the market is pricing in, that's the numbers on the right-hand side. You see that the probability of another hike by the end of the year is pretty low. It's less than 20%. So the market thinks the Fed is done. And then you start looking at what's projected in 2024, 2025. The Fed is saying perhaps one cut next year, but then up to three more in 2025. Well, the market's telling you that they're going to cut even more aggressively. So, while the dynamics may change, one thing that we have a pretty high degree of confidence in is that the Fed is likely done with their rate hiking cycle. They do want to keep rates higher than where we have been, but that will likely ease some of the pressure that we've seen on fixed income. And is one of the reasons why we are getting more and more excited about the bond portion of our portfolios. So we certainly believe that macro is really what drives changes in asset prices over time, but the fundamentals can determine the degree to which they move. So higher valuations on a correction, perhaps you have more downside than otherwise. Lower starting valuation points when stocks come in favor can help you decide which kinds of exposures that you want to own. And with the fundamentals, we certainly start with where valuations are. And from a broad perspective on the left-hand side, you can see S&P is okay. Looking at the last 10 years, roughly 19 and a half times earnings. Not overly expensive, not overly cheap, just okay. But there are sectors that look a lot more interesting, right? We highlighted value stocks earlier in the call. We think from a valuation perspective, those are certainly a lot more attractive compared to growth stocks, which are overvalued here at the 27.8. Stocks outside of the U.S., certainly much cheaper than where we are here currently. And while the rest of the world certainly has a lot of different dynamics that they're dealing with as well, when things do change and this paradigm does shift, we do think there's going to be some significant upside in owning stocks outside of the U.S. From a sector perspective, we call out technology, and it's been one of the areas that has had strength in 2023 after a really rough 2022. They're certainly not cheap by any means. And then you compare that with something like energy stocks, right, which are cheap, have strong earnings growth, and are generally of pretty high quality. You throw in the fact that now we've got some of these geopolitical headwinds and the potential for oil prices to rise, and that just gives you an example of some of the alignment that we're looking for, both from a macro perspective and then from a fundamental or evaluation perspective. And frankly, that's one of the reasons why we've added, for example, in our individual equity portfolios that we run in-house, to energy stocks, and have trimmed a little bit from technology. So the other piece on the fundamental side that we care about for equities is earnings. Obviously, we believe that over the long term, prices follow earnings. And as you can see, really going back to the fourth quarter of last year, we've now had three down quarters of year-over-year earnings growth. And the street is expecting that for the third quarter 2023, which is the earnings season that we're starting now, will likely bottom out and then inflect higher into 2024, up 12%, and then actually another 12% on top of that in 2025. So the street, is still very bullish on earnings expectations. Our comment would be that, that's all well and good, and we can hope for a rosy scenario like that where that may happen. If you look at the broader macro economy and the what's been happening from a growth and inflation perspective, we think the odds of having 2 years of 12% year-over-year earnings growth are not certainly not probable in our estimation. And I'll just give a quick update here. We are about 20% through third quarter earnings season. Right now, sales are up about 4%, which is in line with nominal GDP growth. So we're on track there. And earnings are up about 2%. Earnings per share up 2%. So we could be getting a better than expected result in 3Q, which hopefully will give the equity markets a little bit more fuel to be able to rally into that fourth quarter, as we're certainly all hoping. So then we'll shift gears and turn to bonds, which are normally pretty boring, but happen to be, in our estimation, the most attractive asset class on a 12 to 24 month time horizon, largely because these higher yields, right? So you get the majority of your return from the high rate that you're able to compound. And though while it's been painful for bond investors as yields have come up, now on a go forward basis, the ability to compound these is certainly much more attractive. And on top of that, we think for the first time really in nearly 20 years, bond investors are not only going to be able to compound at higher interest rates, but may have an opportunity for some pretty significant price appreciation on top of that. So one of the questions, Jeff, I know you've gotten it, a lot of our advisors have gotten it, why shouldn't I just lock my money away in CDs? And I'm going to show you a graphic here momentarily as to why we think that may be a bad idea. So looking at the fundamental story for bonds, then you start to think about how you time the bond market cycle, right? Which has certainly been tricky in this environment as the Fed continues to raise rates. The economy remains resilient. But what we looked at as we always do is market history. And what we found is that historically when yields top, or so when interest rates peak out, typically coincides with about the time that the Fed ends their hiking cycle. So if you look back, these are just hiking periods going back to 1980. I keep looking at my wrong screen. I want to show you over here so you can see what I'm pointing at. The peak in the 10-year yield typically happens anywhere from 4 months prior to 4 months after, an average of about 1 month from when the Fed no longer hikes interest rates. And so this is good news because this is exactly what the Fed is telling us that their plan is going forward and is now being priced in by the market. So the timing here is either here or pretty close to here. And so then, if you think about the yield component, what does it look like then from a total return component? And then importantly as well, what are the risks? And that's where this graphic comes into play. And some of you may have seen this when we've had one-on-one calls with advisors. But I love this graphic because what it does is it very clearly illustrates the return and risk of different interest rate levels 1 year out into the future. So looking over here, you see the U.S. 10-year government bond based on different yield levels that range from 6% down to -2%. And so here's where we are today, kind of this 4.5% to 5% yield on the 10-year Treasury. And so if we stay status quo and rates don't move, 1 year from now, you compound your coupon, you get a modest return. We'll call it roughly between 1.5% and 5%. So that's okay. What if we're wrong? What if we're wrong? What if the Fed is wrong, the market is wrong, and rates go higher? Well, you can game that out on this graphic to say that, okay, if we go from 4.5 today to 6 with a 10-year government bond, you're looking at a scenario where you may have some modest losses, right? What if they go higher than 6? Well, anything is possible, though I would say, not probable, just given the fact that one, we can't afford from a fiscal perspective to have interest rates go that high. And then two, the banking system can't afford that either, right? We've already seen what happened earlier in the year with Silicon Valley Bank and some of the other regional banks. So we think that losses, even in a scenario where we're wrong, could be somewhat limited. But what's really exciting is if you look at the other side of the coin, right, in scenarios where rates fall. So on average, again, going back to the 60s, the 10-year treasury falls by 2.5% during recession. So you go from a period of 4.5 to 5, right, down to 2.5 to 3. And not only are you getting that 5% coupon today, but you're getting that price appreciation, and you're looking at a range of anywhere from 15 to 20% in government bonds. 15 to 20% is a great year for stocks. Rarely happens in fixed income, especially when you get you look at the downside of, we'll call it 6, the upside of 20. That's 3-to-1 upside downside. And that sort of asymmetry is what gets us excited as investors and really gets us excited about boring old bonds. So I'm almost done here. I'm going to wrap it up. Just a couple more slides on the behavioral. This is the third leg of our stool, and this really governs more shorter term timeframes. A couple of things to call out here. One, from an institutional positioning perspective, institutional investors are very short bonds. So when the rate move finally does happen, we've all been waiting for it, but when it does finally happen, it is going to happen fast. And the reason for that is because when these positions start going against these institutional investors, they're going to have to buy back those short positions, and that's going to push those bond prices higher very quickly. The other thing I'll call out from this graphic is on the retail side on the right. We've gone from a period of greed, or even extreme greed in some cases back in 2021, to now more of a fear-based sentiment, right? So if we do get this repositioning in markets, we get some strength, we're able to follow through after a nice day today. Perhaps that gets retail more interested and adds more fuel for a potential year-end rally. So why do we think there's a good chance of a year-end rally? A couple of reasons. So just historically, if you look at the long run, fourth quarter on average is the strongest return for equity markets. It is even more so emphasized in years where you've had a 10% return through the first 3 quarters, much like we have experienced this year. I think that's certainly a good sign from a seasonal perspective. But what is really a lot more interesting in the current environment is the fact that the machine, which is again our term for systematic or algorithmic based trading programs, which have become more and more involved in the everyday trading in the equity markets, you can see by the blue line here that this cohort is entirely underweight. Right, they are at levels which are kind of coincide with areas where we've bottomed in the past, and so the idea here is if we do get some follow through, we get some strength in mega cap tech earnings. The machine, which is largely price momentum based, meaning they have to buy when prices are going up, sell when prices are going down, certainly could add fuel to the fire. And push us in a positive direction as we move toward the end of the year. So Jeff, as you know, right, there's certainly no certainty in markets, no certainty to anything in this chaotic world. And as the saying goes, markets can certainly remain irrational longer than you can remain solvent. That's really why we have built our process. It's multi-factor. It's all supported by data. We look at various timeframes from the short term to the long term, and that's what really gives us confidence and what we hope gives our clients confidence in us and the ability to navigate a world of uncertainty, and really to give our clients the best possible chance of investing success. And that's what we do every day, day in, day out, and that's what we're going to continue to do. And I just wanted to take a moment to say thank you for that opportunity.
Well, thanks, Cliff. I mean, again, a lot of information there. Again, everything you had in those slides goes back to our dashboard, right? From the fundamental, the macro, and then the behavioral side of what we're watching. Again, there's a lot more data that Cliff and the investment team are watching. Those are just a few that we always point out and what we're looking at. Cliff, when you were talking the Fed, we got to certainly believe we're closer to the top end with the Fed. And again, when you were showing the next meeting of November 1st, and I think the next was December 13th or 12th, likelihood, of another rate hike, given all that's going on with the Mideast right now, is basically 20% or less, which is very low odds. So as you put it, probably likely that we are done with rate hikes at this point. Could another one come at some, because there's a run in the market, whatever it may be, yes. But given the data today, it looks very unlikely, which I know in our advisor meetings, or a lot of the advisor meetings that I'm having and Rich and I are having with clients, when we're talking about our fixed income portfolios, we're reminding folks that in 2022, going back even to 2021, an area that we were very cognizant of was the duration risk we were taking within our bonds. So as we knew interest rates were going to start to rise, we didn't think they would go from 0 to 5.25. I don't think anybody thought they would happen that quickly, but they did. But ahead of that, we were already moving the duration inward. So we had shorter term, average maybe 2.5 years, meant lower downside. So as interest rates went up, our bond prices were not falling as bad. Now they fell. Bonds have not been a great place to be. Cliff, everything you've been talking about right now has been where fixed income, and we can talk about it here in just a minute. Where do we want to go from here? Fixed income really looks to be a good place to get good returns. I know we're seeing the 5.5 returns that are seeing. A lot of those are short term. Start thinking about where we're switching and we're moving out. We're pushing at where we shortened our duration. Now we're starting to move it out again to lock in some of these returns, because whether it be 12, 18 months, 20, whatever, at some point in time, the Fed will lower rates. How quickly, we'll have to see. But, they will start coming down as the interest rates start to come down. Not only are we getting that coupon, we're also getting the price appreciation in our bonds. So again, there's a lot that was said there. So Cliff, we talked earlier about, where we were in the markets up to this point. You've kind of looked at what the data and where we may be going into year end. So how are we starting to position changes within our portfolios with everything you talked about today?
Yeah, Jeff, and you make a great point. I do want to just harp on the CD question for a moment. As a lot of clients are seeing attractive CD yields, you're able to lock it in for some period of time, 6 months, a year, what have you, and say, well, why shouldn't we do that? We can lock in, take our 5%, and not have any risk on the table. And I guess the first thing I would say to that is money markets also are a really nice option, and in a lot of cases are paying rates that are pretty comparable to CDs. And yeah, a CD can get you a handful of basis points more than a money market can, but what you're giving up, i.e. liquidity, in order to reach for those handful of basis points, in our view, just isn't worth it, right? Because as I've shown, when this rate move does happen, you're going to want to have some duration in your fixed income portfolio. And so having the ability to get out of a money market and buy an ETF or our bond mutual fund portfolio, for example, or even an individual bond, I think is going to be a lot more attractive and a lot more of a efficient use of capital right? To not only get pretty reasonable yields, not quite as much as you're going to get in a CD, but then also that price appreciation opportunity, which again only comes along once every 20 years. And so, for me, my personal opinion is that, it's a mistake to lock up a significant portion of money in CDs. If you want to keep some safe, look at money markets. If you want CDs, at the end of the day, by all means, peace of mind, there is a value to having peace of mind. But I would just hate for folks to miss out on the price appreciation potential because they wanted it to reach for a couple of points in yield. So that's all I'll say on that. But as far as implications go, I kind of laid them out here on this slide. So first, I would say equities that are our least favored asset class. Though I do want to be clear, for the long term, every portfolio should certainly have equity exposure. We're not telling clients to sell out of your stocks by any means. This is all about risk management. So as you're having your year-end meetings with your advisors, there's an opportunity for some tax loss harvesting where you're selling some of your losers for tax purposes. Perhaps think about shifting some of that exposure into fixed income or into alternatives, really depending on what your goals, your objectives are, your liquidity needs. Certainly just something to think about. And then on the bond side, again, which I think I've made the case is our favorite asset class for the next 12 to 24 months. Jeff, to your point, we are now favoring duration. And in our actively managed bond portfolios, we're pushing out duration or what is considered interest rate risk because we do want to have a little bit more exposure to when those rates fall to get a little bit more bang for our buck on the upside. We don't love credit. We'd rather take interest rate risk than credit risk. Spreads are pretty tight, so you're not getting compensated a lot for yield and liquid credit. I think private credit is an area that looks pretty interesting for folks who are okay with locking some money away for longer term periods. And we really want to just be in that high quality spectrum across the board. And then last but not least, as I mentioned earlier in the call, we think alternatives are going to be a much more significant part of portfolios that are designed to have success in this new paradigm in which we believe we have moved into. We believe that alternatives are built for purpose, either diversification or amplification or return enhancing strategies. So certainly do keep an open mind for alternatives. Ask your advisors about whether or not they may be appropriate for you. And I'm certainly happy as well to have conversations for those who are interested. So with that, Jeff, I will kind of just leave it here for a more granular view in our asset allocation. Just kind of corroborates what we've gone over. And I know you've got some pretty exciting planning topics for us to talk about as we move into year end.
Thanks, Cliff. And we're going to keep harping on the CD thing, right? Another area that 2 seconds on that, reinvestment risk, right? The reinvestment risk is if we get a 5% 1-year CD or 18-month CD today, but now 18 months later, 2-year, whatever it is, it's going to be we're reinvesting at another period of time. So again, to your point, Cliff, be mindful of the shorter duration time to maybe start moving out on certain things. So we'll I know in our advisor meetings we're having those discussions. So be mindful of that as well. So Cliff, as you mentioned, I'm just going to kind of wrap up as we close out 2023. Always a reminder in terms of some tax updates or some year-end tax savings strategies, thoughts. First, just a reminder that for 2023, the maximum you could put into, if you're under age 50, that could be put into a 401k is $22,500. So if you have not maxed out, but would like to max out, you've got a couple months left to do so. So take a look at that. If you're over 50, you could do up to 30,000 at this point, because you could do 22.5 plus the additional 7,500 catch-up contribution. So again, log into your 401k, talk with your advisor, see what you can be doing to get that catch up if you're over 50 and you haven't been there, or what you could be doing to get caught up to max out this year. In addition, IRAs, we have a little bit longer time because we go into April until tax filing. But looking at IRA, Roth IRAs, contributing to those if you're able to, based upon your income, $6,500 if you're under 50 for this year, $7,500 if you're over 50. You can do that additional $1,000. Big time of year for our operations staff, and we thank them all because they're working hard behind the scenes right now, because it is time for required minimum distributions. That is what the requirements from the IRS, and whether you need the money or not, you are required to pull money out of your retirement account. So again, I know they're tirelessly working right now to get clients taken care of, get that updated, get you in the right position to make sure you don't have any penalties for not doing so. But also a reminder that things have changed for this year. If you were born between 1951 and 1959, your required minimum distribution age is now 73. If you're born after 1960, your required minimum distribution age would be 75. So for anybody prior to that was taken, you still continue, but depending upon your age and when you were year of birth, when you have to start taking could be as long as you could delay as long as 75 now. We also get ongoing questions. You know, a relative parent passed away and you inherit an IRA. Do I have to take money out? Well, that if they were taking money out, the IRS says you're supposed to. However, over the last few years, they have given guidance to say they're not going to assess any penalties. They did that in 2021. They did it in 2022, and they're doing it again for 2023. So even if you were supposed to, they're saying they will not penalize you for not doing so. But reminder, those inherited IRAs need to be exhausted by the 10th year. You know, Cliff, you mentioned just a few minutes ago, right? Tax harvesting. I know as an investment team, we're doing it all the time. We used to be one of those items we would look closer at year end. It's something that we look out throughout the year now. But if you have outside accounts, good time to look at, are there some losses I have against some gains, or are there, you know, what can I be doing if I sold a home, an investment property, and I have some gains? What can I do to mitigate that tax liability? Well, you could have some losses that could be taken against some of the portfolios you have. You could also look at your charitable donations for the year. Donor advised funds are certainly an ongoing strategy we talk a lot with clients about. But if you don't have a donor advised fund, you could look at bunching your deductions. So maybe I know I'm going to make contributions over the next 2 or 3 years, put them together in one tax year versus spreading it out, because you may not get the tax deduction depending upon where you are in your standard versus your itemized deductions. You could push them out. You know, maybe I don't take it this year. I'm going to give a donation in 24 because it could help me. I'm going to give more in 24 than I am in 23. Again, bunching or pushing those deductions could be something to look at. So talk with your advisor. Also with charitable, again, when you're taking your required minimum distributions, and the IRS, again, when RMDs or required minimum distributions had to start coming out at 70.5, again, that changed to 72, now 73, then 75. But at 70.5, you can gift a portion up to $100,000 of your retirement, your RMD, to a charity. It counts against your RMD, but does not cost you any tax money. It is a tax-free way of giving some money to a charity. You cannot take it as an itemized deduction, but if you give $10,000 as a QCD, it is not taxable, but goes against how much you need to pull out. Lastly, again, ongoing, we talk about this a lot. We run tax projections quite often. I know Rich and I spend a lot of time going over this with clients. I know Jared and Andy, I know Alex, I know John, Matt and Craig. I know we all spend a lot of time, Jeff Powell and Rodney, we spend time looking at the ability for our clients to do these Roth conversions, meaning taking your IRA, paying the tax today, and becoming a Roth account, growing tax-free. Why would I do it? Cliff mentioned our debt a little bit rising, right? Why a 6% or above could be detrimental, not only to our country and our ability to pay, but banks, etc. Rates will not stay, or interest or tax rates are not likely to stay. A lot of them revert back in 2026. They're done at the 12/31 of 2025. We may see tax rates going back to the 37% tax rate, the highest rate today. Will automatically go to 39.6. Doesn't matter who or what Congress president does, unless they do something to keep them where they are, they will change and go revert back to what they were. So tax rates could be lower today than they might be in the future. So a good time to look at Roth conversions, how it could benefit or help you and your family. Definitely continue to look at that. Let's see. I'm going to kind of, Cliff, I think I think you hit on most of the questions. I know the one question that was coming in was on oil, and what do you, and I know this is, you mentioned energy stocks, right? Everything going on in the Mideast. And I'm not going to ask you to tell me what you think a barrel of oil, but I would assume with all the tensions and rising, the likelihood of oil rising in the near future is pretty high. So maybe any thoughts on, the oil market, energy markets, et cetera, right now?
Yeah, Jeff. I think that's certainly top of mind, especially with all the developments going on in the Middle East. Still very early on, so there's a lot of uncertainty about what ultimately the path of this conflict may take. I think we think about the worst case scenario, much like we looked at on that Bloomberg piece. There are various scenarios and probability distribution of what may or may not happen. And we can certainly hope that things remain stable. The conflict remains relegated to the Gaza Strip, perhaps the West Bank. In which case, the price of oil probably comes down a little bit from here, right? Especially if you think about some of the larger macro headwinds, some of the recent economic data out of Europe, out of China as well have been disappointing. And so, you're getting another kind of push-pull dynamic, right? With the potential supply shock, but then emanating from conflict in the Middle East. But then there's also the demand side as well, right? And the U.S. has certainly remained resilient. We're somewhat insulated to oil shocks because we do produce all of our energy needs, and we're actually net exporters. So I think the impact could be much more significant for those that use Brent, right, outside of the U.S. in a supply shock. I think the absolute worst case scenario, just taking the other side, is if somehow Saudi Arabia gets pulled into the fray, right? There are certainly some tensions between Saudi and Iran. Saudi and Israel are not exactly the best of friends, though they've been cooperating here a bit more. But if there is some sort of an attack on a Saudi pipeline, for example, or they get pulled into a broader conflict and production drops off, I mean, I think that's a scenario where you're talking about, instead of $80, $85 a barrel today, I mean, $150, $160 oil would be just a very significant blow to the broader macro economy. That would push inflation higher. It might keep the Fed on track. So, as I said, our thoughts and prayers are certainly with those who are affected at a human level, but I think also from a market perspective, a quick resolution is in everyone's best interest.
Thanks, Cliff. We've got a few more, but I'm going to, to keep our time for the hour here, I'm going to, either I or an advisor or Cliff will reach out on a few of these other questions that we have. We appreciate you sending them in. If you want to reach out to your advisor, feel free to do so, or you want to reach out to Cliff or myself to discuss it, we'll certainly do so. But I'm going to have us reach out to those that we had about 4 or 5 other questions here. So Cliff, I'm going to kind of wrap us up here. I want to thank everyone for joining us today. And again, a reminder that we will, Ashley has been recording, so we'll have this out in a few days. Feel free to share it with, again, your friends and your family, your colleagues, anyone that we can share our guidance and or educate them in any way about the financial world that we're in. We thank you all for your time. You know, we thank you for your continued trust and confidence. You've placed a lot in the Cornerstone team. We understand that. As we do say, we are the cornerstone of our clients' financial lives, and we do not take that lightly at all. So we thank you. Veterans Day, we got Halloween coming up, but I'm going to reach out to our veterans and say thank you to all our veterans out there. We appreciate your service. We appreciate everything you've done. Want to wish everyone a wonderful Thanksgiving. We want to wish everyone a very happy holiday season. If we don't see you before, we wish you and your families the best during this time. Enjoy yourselves, enjoy your family. We wish you good health and prosperity in the year ahead, and we'll look forward to talking to you soon. Thank you, everybody.
Thanks, Jeff.